All right, let's take a look at an analysis question. So it says Fast Cash Corporation shows the following financial position and results for the 3 years ended December 2020, 2021, and 2022. For each year, calculate the current ratio, quick ratio, and for 21 and 22, calculate days payable outstanding. Comment on your results. Okay, so let's start with the current ratio. And this is just going to be current assets divided by current liabilities. So for 2022, we're going to have this amount here, our current assets and our current liabilities, which are all summed for us. So we're going to have 8250 divided by 3,800, which is going to give us 2.17. 2021 is going to give us 7,800 divided by 3,700, which is going to give us 2.11. And then 2020, it's going to give us 7,300 divided by 3,650, which is going to give us 2. So we actually have an improving trend here. So improving trend because our current ratio is increasing as we move forward. So you can see in 21 it was only 2, but by 2017 it's 2.7. So which means that we have more current assets than current liabilities. So that is moving in a favorable direction. All right, so that's the current ratio. What about the quick ratio? So the quick ratio is where we're going to take our quick assets divided by our quick liabilities. What does that mean? It means they're easy to convert into cash. So let's take a look at what that means here. So we've got cash, clearly that counts, investments, accounts receivable, but inventory and prepaid expenses, those are going to take more effort to convert into cash. So we're really just going to be looking at the sum of these items for our quick assets, and accounts payable and accrued liabilities are both quick liabilities. So all of that's going to be in our quick. So this is our quick, and this is our quick here. So essentially we can still use the same subtotal for our current liabilities. Okay, so we're going to say for 2022, it's going to be the sum of 650, 500, and 900. So 650 plus 500 plus 900 divided by our current liabilities of 3,800. That's going to give us 0.54. 2021 is going to be 700, 500, and 1,000. 700 plus 500 plus 1,000 divided by our current liabilities, which are here 3,700. That's going to give us 0.59. And then for 2021, we are going to use 600 plus 500 plus 1,300 divided by 3,650, which is going to give us 0.66. So how is this moving here? So sorry, this should say 2020. So it's actually it's coming down, our quick ratio. And so the quick ratio is deteriorating. So it's actually getting to be worse. So this is a deteriorating trend. We would rather have an increasing ratio, and we actually have a decreasing ratio. And what that means is that our non-quick assets, like our inventory and our prepaid expenses, are increasing as a proportion of our total liabilities. Okay. Last but not least, we've got the average days payable. So let's just make some room for that here. Let's see, we'll put it actually up here. So we're going to put days payable, average days payable, which is going to equal the average AP divided by the average daily cost of goods sold. How in the world are we going to get daily cost of goods sold? It's a great question. Let's take a look at what data we have in this question. We do have the cost of goods sold down here, but we certainly don't have it daily. So let's see what that's going to look like. So we've got, say, let's look for, we can only do this for 2 years because we're doing an average. So for 2022, our average trade AP, which is going to be our AP and our accrued, which is going to be our AP, or average AP. So sorry, AP is going to be 1,500 from 2022 plus the 1,700 from the prior year divided by 2. That's going to give that average. And then over that, we're going to average our daily cost of goods sold. So all we know is cost of goods sold for the whole year was 15,000, but we're going to divide that now by 365. So if you do this calculation and these calculations separately, you'll come out with 39.64 there. And then now we can do the same thing for 2022. I'm just going to put it up here. I'm running out of room here, sorry. So 2021 is going to be our average AP for 2021. It's going to be 1,700 plus the 1,750. So these two amounts here, oops, these two amounts here, divided by 2 plus, this is a plus. And then over that, we're going to divide the cost of goods sold, which is in 2021, 18,000 divided by 365. Okay, here we go. 18,000. What in the world? Not too sure what's going on here. Anyways, 18,000 divided by 365. And ultimately, what we're going to get from there is a current ratio of 34.98, which it won't let me write. So basically, our average days payable outstanding, or days payable outstanding, went from 34.98 in 2021 to the 39.54 we have here. So it is getting an increasing time period for the company to pay off its current liabilities. So that's not a great trend either. So hopefully that helps with the analysis question. Sorry about running out of room, but it does give you a good idea of how to work through a question like that if you see it on an exam.